Assalamu alaikum everyone. I hope you are doing fine. I'm here with the discussion of chapter number 10 of managerial accounting, that is planning for capital investments. We will be using different techniques to evaluate different investment opportunities, and most of them are relevant to the time value of money. The chapter discussion we are already done with. Now let's solve some exercises for planning for capital investment. Starting with our first exercise, that is exercise number, I will just use my pen, 1 second. Yes, exercise number 10-2. Larry Mattingly turned 20 years old today, so this is his age. His grandfather had established a trust fund that will pay him $120,000 on his next birthday. Next means when he will turn 21 years old, so 1 year. However, Larry needs money today to start his college education, and his father is willing to help. So his father is saying, yeah, he can help him. Mr. Mattingly, means his father, has agreed to give Larry the present value of 120,000 future cash inflows, assuming a 6% rate of return. Now this 120,000 he will be receiving next year, means after a year. His father says he can give him the funds by turning these funds to the present value, means bringing that value equal to today's value, and the rate of return will be 6%. They say round your figures to the nearest whole dollars, means we don't need points, we need to round it off. Use the present value table. So when they are asking us to use the table, so we will be taking the help of the table to determine the amount of cash that Larry Mattingly's father should give him. So his father will give him that cash. So what he is willing to give, he says that he will give the present value of 120,000. Now we all know that the present value is equal to the future value multiplied by present value in interest factor, and if you see the rate of interest, that is 6%. So let's go to the table of present value. This is the present value table. Let's again see the rate of interest is 6%, and it's 1 year. Why 1 year? Because next year he's gonna receive, we are standing 1 year before, so that N is 1 year. So let's see what is the factor for 1 year at 6% rate. So let's go back to this. This is 6% rate, and the factor is 0.94340. Okay, so I'm using this factor to calculate the present value. So here is it. 120,000 is the future value, and this is 0.94. In the table it was 340. This is from another table where they are taking more decimal places, so if you round it off, it is 40, right? Anyways, when you multiply, the present value is 113,208. So this is the value his father will give him today instead of 120,000. Point number B says that use an algebraic formula to prove that the present value of the trust fund, means this value which we just calculated, is equal to 120,000 future value. So if this is the present value, we add 1 year interest of 6% into this, we will get the future value of 120,000, right? So present value is 113,208 plus interest on this value equals to 120,000. So this is the equation proof for this, or you can say algebraic formula proof for this. Let's move on towards next question. Gail Trevino expects to receive 500,000 cash benefit when she retires 5 years from today. 5 years from today. Miss Trevino's employer has offered an early retirement incentive by agreeing to pay her $325,000 today if she agrees to retire immediately. If she retires today, she will be receiving $325,000, and if she retires after 5 years, she will be receiving $500,000, right? Miss Trevino desires to earn a rate of return of 8%. Again, they want us to round off the answer. assume that the retirement benefit is the only consideration in making the retirement decision. So this benefit is the only thing, she's not receiving anything else. Should Miss Trivano accept her employer's offer? So we know that we can check it if we calculate the present value of this amount and see, is it equal to 325,000? If it is equal or less than 325,000, Miss Trivano should accept this, right? Because this is more. But if the present value of 500,000 is more than 325,000, so the employer is not justifying even with the rule of present value, right? So she shouldn't accept. So let's see. I will be calculating the present value of this future amount, 500,000. The rate of interest is 8% and the life is 5 years. 8% for 5 years. Let's go to the table. This is 8% here and the 5 years is over here. So the rate, the interest factor is 0.68058. So let's use this 0.68058. Here one more decimal place they have used, but you can use the same factor. When you multiply the present value for this future amount, it's 340,292. So if employer wants her to retire, he should give her this amount. This is the present value of 500,000, not 325,000, which is less than even the present value. So Ms. Trivano should not accept this offer. Okay, point number B is identify the factor that caused the present value of retirement benefit to be less than 500. They say why the present value is less than the 500,000. So there are many things because of inflation, because of the interest factor, because of the risk. These things are the reason why the future value is not equal to the present value. Let's move on towards the next question. I'll just make the view a bit bigger so that it's easy to read. I think this much is okay. Let's use the pen. Okay. The Dean of the School of Fine Arts is trying to decide whether to purchase a copy machine to place in the lobby of the building. The machine would add to the students' convenience, but the Dean feels compelled to earn 8% return on the investment of the fund. So if he wants to purchase this machine, he wants a return of 8%. Estimate of cash inflows from the copying machine that have been placed in other university buildings indicate that the copy machine would probably produce incremental cash inflows of approximately 25,000 per year. So every year the machine will be bringing $25,000 cash inflow. The machine is expected to have a life of 3 years. So it means that 3 years you will be getting this 25,000 from the machine every year, and there is zero salvage value. Round your figures to 2 decimal points. Now what we are supposed to do, point number A is use present value appendix table 1. The present value is appendix table 1 is the simple present value to determine the maximum amount of cash the dean should be willing to pay for the copying machine. See, if you invest, you want to get return, or you can say you want to at least recover your money. So every year this machine will be giving 25,000. If we do not have any concept of time value of money, we can multiply this 25,000 with 3 and we will be saying 75,000. So he should not invest more than 75,000. He should invest less than 75,000 because the money inflow which this machine is bringing, that is 75,000. We can apply the same concept with the help of time value of money. Instead of taking 25,000 straightforward, we can take the present value of 25,000, add those 3 values because I cannot multiply, all of them will be different. So add those 3 values and say that less than this the investment money should be, right? Because they say use the simple present value table, not the annuity table. So what I will be doing, first year I'll be collecting $25,000. So present value factor, the rate of return, if you see, they gave us 8%. So I will go to the present value table. I showed you 2 times. Present value tables, 8% is rate, and for 1 year, because 25,000 is for the year 1. this is for year 2, this is after year 3. Okay, so when I calculate the factor, I get the factor and I multiply it, the present value of 25,000 at the end of first year, that present value today is 23,148.15. After 2 years, again it will give us 25,000. If we want to calculate the present value, we should get the factor of 2 years, 8%, right? And then this is the present value. And for the third year, I need the factor of the 3 years, and 8% is the rate, and this is the present value. So when I add all of them, that comes up 64,427.43. so it means that the dean should not invest more than 64,000 in purchasing this machine. He should invest less than 64,000, otherwise he will be at a loss. Point number B says that use present value appendix table 2. This means that use the annuity table, and we all know what is annuity, right? The same amount you receive every year for a specified time period. So every year means, or the same time interval. So 25,000, 25,000, 25,000. I can use annuity table. So what I will be doing, I'll be using the second table. I'll take you to that. 25,000 annuity for 3 years, because 3 payments they said. 3 years, the rate is 8%. So let's go to the annuity table, not this one. This one is the annuity table, and I forget the rate. The rate is 8%. So this is 8%, and for 3 years this is 2.57710. okay, so this one, let's go this here, 2.5770809. sorry, this factor, you copy that factor which I just showed you. Some decimals are different, and then when I multiply it with 25,000, this is the present value. So you can see both present values are the same. You do it in parts, you do it with the help of annuity, you will get the same answer, right? Point number C says that explain the consistency or lack of consistency in the answers to requirement A and B. There is consistency, both of them are same. And why both of them are same? Because here I use the broken factor, 3 different factors, and when I add these 3 factors, I will get this combined factor which I can find from the annuity table. So one time this factor, if I multiply it with the future value, I get the whole result of annuity, right? Let's move on towards exercise number 10-5. Monterey Company is considering investing in 2 new vans that are expected to generate combined cash inflow of 30,000 per year. Do remember, this is combined money for both vans, and its inflow, this is what they will generate. The van's combined purchase price is 93,000. So this is the full money we have to pay to buy these 2 vans. The expected life and the salvage value of each are 4 years. So each means now this is not combined. Both of them have 4 years life, and the salvage value, both of them have salvage value of 23,000. So you know that salvage value is an inflow, purchase price is an outflow. You have to spend the money, and this is also an inflow revenue, 30,000, right? Monterey has an average cost of capital of 7%. So this is our discount rate. They want us to calculate the net present value, not the present value, net present value. So net present value, we all know that the present value of inflow minus present value of outflow gives us net present value, right? So let's do this one. Inflows, we have 2 inflows. If you see 30,000, this is every year we will be receiving, do remember, and for 4 years we will keep on receiving it, right? So 30,000, and for 4 years we will be receiving it. So do remember, n is, I wrote it down, let me show you here. So n is 4, and because 4 years you will be receiving it, and discount rate they said 7%. So 7%, because this 30,000 is repeated amount, so I can use the annuity table for this. Do not focus on the table numbers, because every table means every book has a different number for annuity tables. So the one which I'm showing you again and again, you can see that table 4 is for annuity and table 2 is for the single amount, but the reference which we have, that's different. So please, table numbers are not the benchmark. Okay, so N is 4 and 7% and 30,000 every year, because this inflow will be there. So I will be using the annuity table for 4 years, and rate is 7%. So let's quickly do this. This is annuity table. This is 4 years and the rate is 7%. So let's go there. This one, 3.38721. See here, 3.38721, because they are taking one factor more. Okay, and then this is also inflow, because I said inflows minus outflow. So one inflow is this every year, and 23,000 at the end of the life in form of salvage value. So after 4 years, only one time we will receive 23,000 for van A, also 23,000 for van B, because they said each. So together we will be receiving 46,000 for both vans, right? So 46,000. But this is not an annuity, because this is one time receipt after 4 years. So for this I will be using single amount table. This one, after 4 years, 7% rate, so 0.76290, 0.76, because I use less numbers, so 290. If you round off, you can see that it's 290. Anyways, multiply them, you get the present value of 2 inflows. Add them so that you have present value of total inflow. This answer 136,709.50. Then minus present value of outflow. If you see in this whole scenario, we have only one outflow, and that is already in present, because you have to purchase today, right? So 93,000. No need to calculate in this question the present value of outflow. Okay, so present value of inflow minus present value of outflow, you get your net present value. This is positive. It means that you are getting more inflows than the outflow. So they said that, should we accept this investment opportunity? Yes, we should. Why? Because inflows are more than the outflow. Moving on towards exercise number 10-6, Arun Heath is seeking part-time employment while he attends the school. He's considering purchasing technical equipment that will enable him to start a small training service company that will offer tutorial services over the internet. So he wants to do this small business. Arun expects demand for the services to grow rapidly in the first 2 years of operations as customers learn about the availability of the internet assistance. So he says that in the first 2 years there will be an increase in the inflows, and thereafter he expects demands to stabilize. So after that there will be a stabilized demand. The following table presents the expected cash flows. When they say cash flows, to inflows and outflows. So in 2019 he expects 25,000 inflow, 12,000 outflow, then 29,000 inflow, 16,000 outflow. In 2022 he expects 32,000 inflow and 18,000 outflow. So different. In addition to these cash flows, Arun expects to pay 25,000 for the equipment. This is the purchase price of the equipment. This is also an outflow, and in the first year, means start of the year, present, right? This is already present value. He also expects to pay $4,000 for the major overhaul and updating of the equipment at the end of the second year of operations. So this he has to pay. This is also an outflow at the second year of operation. So in second year we don't have outflow of 16,000, we also have 4,000. Okay, the equipment is expected to have 4,000 salvage value and a 4 years useful life. So if you see over here, salvage value is also an inflow, and you receive salvage value at the end of the life, so means the 4th year. So in 4th year you don't have an inflow of 32,000, you also have salvage value inflow of 4,000. His desired rate of return is 8%, again 2 decimal places. Calculate the net present value of the investment opportunity. What is the net present value? Present value of inflows minus present value of outflows. These are inflows and these are outflows. Okay, so let's do this. If you see over here, I took, instead of doing present value for all these 8 amounts, let's do the net amount every year and then calculate its present value. So inflow for first year is 25, outflow is 12, so when you minus it, that is 13. Then after that, inflow of 2020 is 29, and then 20,000. Why 20,000? Because if you remember, we added the maintenance in this. Okay, and do remember, I have not considered the purchase price as outflow in the first year. Why? Because this outflow is at the end of the first year. It needs present value calculation, but the purchase price is not, it doesn't need present value calculation. So that's why we will be handling it at the end. Then second year is done. Third year 32,000 and 18,000. Fourth year, if you see, it's 32, but 4,000 is salvage value, so that becomes 36 and 18,000, so 18,000 is net. Now go to the present value table, single amount, not annuity, because this is not repeated. 13,000 multiplied by 1 year interest factor at 8%, 9,000 multiplied by 2 years interest factor at 8%, 14,000 multiplied by 3 years interest factor at 8%, and this is 4 years interest factor at 8%. We get our present values and then I net them off. So these are my inflows values. Why? Because all answers are positive, and you can see every net value gave me an extra inflow, right? But we have an initial outflow of purchase, so I need to minus that as well. So from this inflow minus the outflow, original outflow, I get my net present value. Then they say indicate whether the investment opportunity is expected to earn a return that is above or below the desired rate of return. The desired rate of return is 8%. If your net present value is positive, means your inflows are more than outflows. It means that you are earning more than your desired rate of return. Okay, so yes, it earns more. That's why we have net present value positive. Moving on towards a next question, Rolla Company has a choice of 2 investment alternatives. The present value of cash inflows and outflows for the first alternate is 125,000 and 100,000. So this is inflow and this is outflow. The present value of cash inflow and outflow for the second alternative is 300,000 and 262,000 and 500 respectively. They say calculate the net present value of each investment opportunity. Can you see? This is present value of, so they already calculated the present values for us. We don't need to. We just need to net them off to calculate the net present value. So alternate 1 is cash inflows minus outflows, net present value is 25,000. Alternate B is 300,000 minus 262,500. Net present value is 37,500. Option number B says that calculate the present value index. So present value index formula is present value of cash inflows divided by present value of cash outflows. So inflows present value divided by outflows present value, and we get index as well. Point number C says that indicate which investment will produce higher rate of return. So of course the one who gives us more net present value or more net present value index, that will give us more higher return. So if you see over here, this one is net present value that is giving us 37,500. So this is giving us more net present value as compared to the alternate B. If you see present value index, it shows us opposite results. It says 1.25 here and 1.14 here. So do remember, net present value has more priority over the present value index, because index is calculated with the base, but net present value tells us really what extra, what residual earnings or inflows you will have over the outflows. So decision should be based on net present value. Moving on towards exercise number 10-8. To open a new store, Enid Tire Company plans to invest 320,000 in equipment expected to have a 4 years useful life, no salvage value. So this they have to invest outflow. Enid expects the new store to generate annual cash revenue of 400,000 and to incur the annual cash operating expenses of 240,000. And its average income tax rate is 30%. Company use straight line depreciation method. Requirement is determine the expected annual net cash inflow from operations for the first 4 years after he opens the store. So we need to calculate the net cash inflows, no net present value or something, just net cash inflows. So every year the revenue is 400,000, but we know that this is not our inflow. We know that the difference between cash flow from operating activities and net income is non-cash expenses and some accruals, right, and some deferrals. So in this scenario we have something known as depreciation, which is non-cash expense, right? So we need to convert our net income into cash flow from operations, or you can say inflow, cash inflow from operations. So let's do this. Firstly calculate net income and then we will do conversion. So revenues are 400,000, operating expenses are 240,000. Depreciation we have to calculate because they didn't say it includes the depreciation. So as equipment costs 320,000, there is no salvage value. Life is 4 years. Where is it? Yes, 4 years, and there is no residual value. So cost divided by 4 years, every year depreciation is going to be 80,000. So income before tax comes up 80,000. From revenue I minus these two expenses, and then the tax rate is for 30%. So 30% of this taxable income is 24,000. So net income becomes 56,000. Now we get the net income. Let's convert it into cash inflow by adding back non-cash expenditures. So that is only depreciation. So if I add back the depreciation, my net cash inflow becomes 136,000. Okay. This cash inflow we will have in year 1 and year 2. We will have it in year 2, year 3 and year 4. But in year 1 we will not have this net cash inflow. Net means now net if any outflow is there or not. So in year 1 we also have, this one investment outflow. So we actually have this inflow, but outflow is higher, 320,000. Okay, so that's why we have actually net cash outflow in the year 1, not inflow. But year 2, 3 and 4 we have net cash inflows. Okay, this is exercise number 10-9. Gertie Manufacturing Company has an opportunity to purchase some technological advanced equipment that will reduce company's cash outflows for operating expenses by 640,000. So this much amount of expenses will decrease if he invests in this equipment. The cost of equipment is 3,932,522.88. Gertie expects it to have a 10 years useful life with zero salvage value. The company has established an investment opportunity hurdle rate is 9%, means if the investment provides more than this, they are going to invest in that. If the rate will be less than this, they are not going to invest in this option. Use the straight line method for the depreciation. Requirement is round your computation to the 2 decimal points. Calculate the internal rate of return of the investment opportunity, means how much return this investment opportunity provides. In all the previous questions, what we were doing, every year return, whatever we expect, or you can say every year net cash flow, we were multiplying it with the factor. The factor was either annuity factor, or the factor was either single value present value factor. Single value present factor, and then we were getting the present value for our investment. But in this question we need to find out this rate, the rate which we are using, that we need to find out, because we know that how much return we will be getting every year. We know what is the present value of our investment, but how much return this investment is providing, that is required. Now if you see the amount which we are receiving every year, that is same amount, so we can use annuity formula. The life is 10 years, right? Do remember. So what we do usually, rate multiplied by the repeated amount, which is 600, and it's over here, the present value table factor multiplied by the repeated amount. So this one is, you know, don't forget, this one is annuity because it's repeated amount, it's not single amount. Is equal to your answer, or the present value, or the investment which you are going to do today. Now if I want to find this factor, I need to divide this amount with this one. So when I divide it, the factor becomes 6.144567. I'll go to annuity table. I know the life is 10 years, so two things I know: rate I need to figure out. So let's go there. This is the single amount, this is the annuity table. From the formula I identify. So if you remember the factor was 6.14456. okay, so let's go here. This is 10 years row, this one, drag you and find out where is the rate. So can you see this one? At 10% I can find out 6.14457, right? It's almost nearby. 6.144 I do have. So the internal rate of return, or you can say IRR, for this investment is 10% according to my calculation. This 10% return is greater than my hurdle rate of 9%. So this investment is providing me higher return. So yes, we will be investing in this opportunity. So that here what I just said. Moving on towards the next one, Velma and Koita is a partnership that owns a small company. It is considering two alternative investment opportunities. The first investment opportunity will have a 5 years useful life, will cost 19,680.96 and will generate expected cash flow of 4,800 per year every year. Okay. The second investment is expected to have a useful life of 3 years. The first one was having 5 years life. Okay, and will cost 12,885.48 and will generate expected cash flow of 5,000 per year. Assume that V and K has the fund available to accept only one of the opportunity. They want us to calculate IRR for both the investment opportunities. So same way I'm going to do the repeated amount, and this is the repeated amount, and the investment, present investment, which I need to do. When I divide the present investment with the repeated amount, I get factor. I'll go to the present value annuity table, and according to the life I will be searching for the rate. Okay, so see here, first investment, this is the investment I need to do, and this is the return every year I'll be getting. So my factor becomes 4.1002. The life for this investment is 5 years. If you see over here, they wrote it 5 years. So let's go to the table and try to find out 4.1002. So this is 5 years, 4.1, where is it? This one, 4.1002. So this is nearby. So 7% is IRR for the first investment. Okay, or approximately 7%. Second investment, I need to invest 12,885 and it returns me 5,000 every year. For how many years? For 3 years. Okay, so let's find out the factor first, that is 2.577, and let's go to the table, and for 3 years we'll find out 2.577. This is 3 years and 2.577. Where is it? This one, 2.577. So its IRR is 8%. Okay, approximately 8%. Based on the IRR, which opportunity you should choose? So first opportunity give us return of 7%, second gives us 8%, so we should choose option 2. Discuss other factors they should consider in making the investment decision. So let me show you from here. First investment opportunity needs 19,000. Second investment opportunity needs 12,000. So okay, 12,000 seems less costly than 19,000, so we should take care about the amount. Second important thing is 5 years life. First investment opportunity, though it's provide you 7% return, but it will keep on providing you 7% return for 5 years, whereas second investment opportunity will give you a return of 8% and only for 3 years. After 3 years you need to think about where to invest again, right? So these are some other factors we need to consider, so I wrote them over here. Moving on towards the next topic, which is payback period. North Airline Company is considering expanding its territory. The company has an opportunity to purchase one of the two different airplanes. The first airplane is expected to cost $12 million. It will enable the company to increase its annual cash inflow by $4 million per year. The plane is expected to have a useful life of 5 years and no salvage value. The second plane costs $24 million. It will enable the company to increase annual cash flow by $6 million per year. This plane has an 8-year useful life and zero salvage value. Determine the payback period for each investment alternative and identify the alternative note should accept. Okay, so payback period, we all know that it does not consider the time value of money, and the formula, simple one, is if the cash flows are equal, if they are even, so we divide our investment with the annual cash flow to calculate the payback period. So for the first alternative, its cost divided by annual cash flow, you get 3 years, and for the second one, when you divide them, 4 years. So the one who gives you back money first, that is more acceptable, so option A looks good. Okay, they say what are the shortcomings, or you can say drawbacks, of the payback period. So one is that it does not consider the time value of money, and the second one is after the recovery there is still the time you will be receiving the cash inflows. So payback period ignores the cash inflows or outflows which comes after the payback time. Moving on towards the payback period for uneven cash flows. I cannot use the straightforward formula of investment divided by cash inflows. So what should I do? I will be using another way to calculate the payback period if the amounts are uneven. Curry Company has an opportunity to purchase a forklift to use in its heavy equipment rental business. The forklift would be leased on an annual basis during its first 2 years of operations, so they can lease it out for the first 2 years. Therefore it would be leased to the general public on demand. Curry would sell it at the end of the 5th year of its useful life, and we have some expected cash flows. Can you see 5 years of its life we have? So 2018 first year they will purchase it, then 2018 revenue is there, 2019, then 2020 there is a revenue but they have to do some maintenance, 2021 revenue, 2022 revenue, and 2022 salvage value is also there. Determine the payback period. Now these are uneven amounts, so we have two different methods to calculate the payback period if we have uneven amounts. The number one is known as accumulated cash flow approach. So what is accumulated cash flow approach? Accumulated cash flow approach means that you need all the years what you are supposed to do, you need to just keep on adding your net cash flow every year until you recover, because it's payback now, so until you recover your initial investment. So your initial investment is 86,000, this you should recover. So first year you have a net revenue of 30,000, there is no outflow, so this is an inflow you will receive. The second year you will receive 40,000 inflow, so you will this is also an inflow, together they are 70,000. I need 86,000. Third year 28,000 is an inflow, okay, but at the third year I also have an outflow of 12,000, so I'll net it off. When I net it off at the end of the third year I got 86,000. So can you see, this is year 1, year 2, and this is year 3, 2020. So 3 years is the payback according to the accumulated cash flow approach. The second one is payback period using average cash flow approach. So what should we do? We will be calculating the average inflows and outflows, and then we will be that we will consider as an inflow, and we will divide the cost with that. So do remember, in order to calculate the average, take the life. Don't take 1 2 3. No, the life is 5 years, so we will be dividing the total amounts with the 5 years. So how I'm going to do that? 30,000 plus 40,000 plus 28,000 minus 12,000 plus 20 plus 14 plus 9,600 divided by life, which is 5 years. So when I do that, average cash flow becomes 226,000. Now I can use my initial formula, which was for even amount, so cost divided by your average inflow, so you get 3.3 years rounded figure for the payback period. Okay, let's move towards our next question, which is determining the unadjusted rate of return. This is Rainbow Painting Company is considering whether to purchase a new spray paint machine that costs $16,000. The machine is expected to save labor, increasing the net income by $1,200 per year. The effective life of the machine is 15 years according to the manufacturer's estimate. They say determine the unadjusted rate of return based on average cost of investment. You know that we have a formula of average cost of investment. So what's the formula? Incremental increase in the net income every year divided by whatever is the cost, divide it with 2. You don't need to go into the derivation. Just remember that it does not depend on the life. Don't divide it with 15. It's divided by 2. It's in the formula to calculate the average cost of original investment. So basically divided by 2 is the part of your formula. So 1,200 divided by 16,000, which is your investment, divided by 2, the part of formula. So rate becomes 0.15 something. So when I multiply it with 100, that becomes 15%. They say what is the negative point? So of course unadjusted rate of return is also another method which does not consider the time value of money. So 2 methods we are doing which does not consider the time value of money. One is the payback period and the second one is unadjusted rate of return. Moving on towards the next one, which is Garrison Rentals can purchase a van that costs $54,000. It has an expected useful life of 3 years and no salvage value. Garrison use straight line depreciation. Expected revenue is $36,000 per year. This is revenue. Assume that depreciation is only expense associated with this investment. So net income we need to calculate. Anyways, determine the payback period. But before that, let's do this and then move on towards the next part. So payback period is cost divided by the inflows which you are receiving. So cost is 54,000 and inflows are 36,000. So 1.5 year is the payback period. Determine the unadjusted rate of return based on, again, average cost of investment. So the formula we all know that the incremental one second, let me just take you back. Incremental increase in net income divided by average cost of original investment. So how do we calculate average cost of original investment? That is cost of original investment divided by 2. So firstly we need to calculate the incremental increase in the net income. So we don't have that, so let's calculate. Revenue minus expenses gives us net income. So revenue is 36,000. Expenses, we can calculate the depreciation expense. So I'm doing it over here. 54,000 is the cost of machine. Life is 3 years, so 18,000 every year. So revenue minus expense gives me 18,000 incremental income. So income divided by average cost of investment, that is 54,000 divided by 2. So the return becomes 66.7%. So this is it about the discussion for your chapter number 10. I hope you are able to understand the time value methods and the methods which ignores the time value for the calculation or for the evaluation of the long-term investment opportunities. If something is confusing you, please write in the comment section or you can email me. Wish you good luck, and I'll come back with another recording of another topic soon. Take care everyone. Have a great day.